This is our first quarter of 2016. We've already had a year of abrupt reversals. Remember what happened in January and the first 2 weeks of February? A steep decline in the Standard & Poor's 500 index, 10.5%. Maybe some of your mutual funds went down even more than that, from 1231.15 to 211.16. And then amazingly, within 5 weeks, all those losses had been gained back, and we're now in plus territory for the year. It has been the most dramatic turnaround for the headline stock indexes since 1933. So do we have anybody here who was alive in 1933 and remembers, well, you probably don't remember what was happening then if you were alive at that point. But that was an astonishing year when Franklin Roosevelt took office. We had the bank holiday, and all the banks in the USA had to shut down for about a week. And then the stock market had anticipated all of this trouble, was plunging in the first quarter of 1933. And then as soon as Roosevelt declared the bank holiday, people started thinking, wait a minute, this means that the successful banks are going to survive. The country is not coming to an end, and sure enough, the market turned around, went right back up. Now, this time around, what was the sequence of events? It's not, we weren't going through the Great Depression, to be sure, but there was a lot of fear out there in January, early February, about what? OIL, crashing oil prices. Great for people who are buying gasoline at the pump, but not so good if you are an operator in the oil industry, not so good if you're a banker lending money to the oil industry. So there was a great deal of fear at that point that the oil crash would lead to some kind of financial crisis, perhaps a recession and a financial crisis. Instead, what happened, surprisingly, is that the price of oil turned around, stabilized, began climbing back again, and at this point, the oil market seems to have stabilized at around $39, $40 per barrel, basis the West Texas oil, and so investors are feeling, well, it's low enough to deliver cheap gasoline. I'm still paying about $2 a gallon, which is certainly a lot less than I was paying 2 or 3 years ago, but it's high enough for the oil industry in the USA to survive. So the Armageddon, so to speak, has been postponed once again, and that's why the market turned around. We did very well in our model portfolio in the first quarter. We were up 3.6% in the first quarter, and that's compared with a 1.3% gain in the Standard & Poor's 500 stock index, and 1.9% in the mutual fund that I love to compare ourselves against. I must say they are very tough competition. That is the Vanguard Wellington Fund. If you own Vanguard Wellington, you should be very happy. I've recommended it for about a quarter of a century now as kind of a set-it-and-forget-it fund. And in the last quarter and even in the last 12 months, we've been able to beat the Vanguard Wellington Fund. So, yeah, I think if we were able to do that, in a 12-month period when the markets have been so tough, I'm very happy about that. So we've been able to negotiate this tough market so far, not perfectly, but at least we have been doing it profitably. Now, what happened here in February? And I'm going to run you through a few slides here to give you some indication of why I think this recovery is for real. That's the big question in people's minds. Are we going to go right back down again, or will this recovery continue? And I'd like to suggest to you that there are some subtle signs the market is giving us, little signals. You have to listen to the market. The market doesn't usually shout, it whispers. You have to listen carefully, and there are little clues that are telling us the rest of the year is going to be all right. I'm happy to bring that kind of news. And the first indication is the sharpness of this recovery that occurred, and I've circled it for you on the slide back there in February. I mean, a dramatic move up. And this slide is now a couple of weeks old, but the recovery has continued. It's somewhat similar to the V-shaped bottom that we had last September. If you look a little further to the left on that chart, you see a sharp rise in late September and through, say, the first half of October. But this recovery has been different from the one last fall in that the market has not given back much of its ground. It's been very reluctant to give back ground. Have you noticed that as you've been watching the day-to-day reports on CNBC or whatever news outlet you're following? We've had a few down days, but it seems whenever there's a down day, the market comes back the next day. And so it's been much more resilient. There's a good word if you're taking notes. The market has been more resilient this time around than it was last fall after this V-shaped bottom. And the question, of course, that we have to ask ourselves is whether these good times can last. And a couple of things are telling us, I think, that they will last. First of all, the resilience that I told you about. The oil price has stayed up here around $40, and the junk bond spread, which had blown way out. This is now the difference in yields between junk bonds, lower rated speculative corporate bonds, and treasuries that had blown out back in February to over 800 basis points. Now it's come down again. It's around 700. And we also had at the end of last year a worrisome uptick in jobless claims. I'm talking about people going to the unemployment office for the first time to pick up their check. That has also subsided. So I'm watching for I'm watching these factors here. If the oil price remains above $30, if the junk spread remains below 800, which is kind of a fever thermometer of the conditions in the credit markets, if the jobless claims remain below 300,000, then that would be an indication that things are stabilizing and perhaps improving somewhat. And I think this may be where we're headed. The clues seem to be pointing in that direction. Here's one more clue that I want to share with you. And that is just the power of this advance that we had coming off the bottom in February. For the first month, 20 days being essentially one trading month, there are 5 days in a week, so 20 days would be essentially 1 month's trading. And what I do is you can perhaps tell that this is a spreadsheet that I keep on my computer, so I compute this every day. This is an indicator I watch for you every day. And I'm looking at the 20-day running total of advancing stocks on the New York Stock Exchange, and I divide it by the 20-day running total of declining stocks each day. Have you ever watched CNBC? They'll say today there are 2,000 stocks up and 1,000 down, 2,000 advancers, 1,000 decliners. And so that ratio would be 2 to 1 on that particular day. Well, I keep a 20-day running total. And I found that we had in March the highest reading since 2009. So this was almost a 7-year high. And this is the kind of thing that happens very, very rarely. It last happened in 2009 when you get this big reading above 1.75. Previous to that, the last time we had a reading this high was in February 1991. Anybody remember what was going on in February 1991? Let's stretch some memories here. Anyone? Can you remember? Yes, in the back there. Yes, the first Gulf War. And remember how in the lead up to the first Gulf War, people were worried, how's this going to turn out? This is a new experience for the USA. Are we getting ourselves in over our heads? This is the first Gulf War I'm talking about, not the Iraq War, the first one. And sure enough, within a matter of weeks, the Iraqi forces had been pushed out of Kuwait, and that objective had been achieved. And when people realized that the Gulf War was not going to widen at that point, and that the economic recovery was going to take root, then the stock market took off, and that was an indicator kind of like a big shot out of the gun that tells you times have changed, things are going to get better. And they remained better actually for several years, from February 1991 really to February of 1994. The market was heading up. So we had 3 more years after that. I don't know that we've got 3 more years on this one, but I think maybe we've got another good 6 to 9 months, and that's an opportunity. So you want to reorient your thinking. Remember, back in December, January, we were kind of digging in for tough times. That's really how the topic of this presentation came about. I was asked to give this topic about 8 weeks ago. So at that time, we were thinking times might still be pretty tough in 2016. But since then, there's been a dramatic turnaround, and we need to move with the evidence. You don't want to be a stopped clock. You want to adjust as the clues come in and tell you that things are either getting better or they're getting worse. And they are getting better, and that's why we've been buying more stocks. Now, why do I say I don't think it'll be another 3 years like the run there from 1991 to 94? The problem we're facing is that stocks are not cheap. Generally speaking, they are not cheap, and I have, I think, run this chart in our March issue. So you probably saw this chart in our March newsletter. This is the price-earnings ratio for the whole market, the S&P 500 index, looking forward 1 year, using the earnings estimates for 1 year forward. And you can see here, this is a 10-year chart going back to 2006. Where are we now? Well, we're not at the very high point. That was reached in the first quarter of 2015, that very high point of above 17. But we're at 16.4, and I think it's actually risen a little in the last week or two. So we may be more like 16.6 right now. So we're not far from the highest price-earnings ratio on the market in the last 10 years. Could it go even higher than the 10-year high? Yeah, there's nothing that says it can't go somewhat higher, but you're starting to bet against the casino when you assume that it's going to go much higher than the 17 times earnings. You're betting against the casino, and any of you have been to Las Vegas, you know how that works. You can feel really smart for a while if you win against the casino a couple of hands, and then somehow the house always seems to come back. And that's what happens when the market gets too high, as it did, remember in 1998 and 9, it just kept going and going and going. And many folks got to the point where they thought it would never stop. And sure enough, one day it just ran into a brick wall. So you want to be careful that you don't overpay. That's my message. Be optimistic, be positive. There's too much negativism out there. Maybe you saw the post that I wrote on Thursday about all these folks that are betting against the market, selling short. You don't want to be in that camp where you're expecting doomsday. Not right now. Doesn't look like it. There are just too many clues pointing to the upside. But don't get carried away and think that this will last forever, that we're going sky high the way we did in the late 1990s. It's not going to be another internet bubble. You have to keep your feet planted on the ground. And as long as you do that, optimistic but careful, I think you'll be fine this year. And that's really what we're trying to do. Okay, how do we buy wisely in this type of market where maybe we have a little tailwind behind us, things are positive, but we don't want to get carried away? First of all, you want to focus on quality. Quality meaning companies that have entrenched franchises, good balance sheets, not too much debt, and as we often talk about in our newsletter, a record of increasing, dividends. Dividends. Who likes to earn dividends? I mean, I hope somebody does in this audience. All right. Increasing dividends. The longer the record, the better. All right. So strong business franchise, not too much debt, increasing dividends. That's quality, in a word. That is quality. Okay. Now further, we want to screen a little more in depth here. We want to try to buy things at a relatively low price earnings ratio. Remember, I told you the market as a whole is at close to a 10-year high. We don't want to buy things that are at a 10-year high. Maybe they'll go higher, but you're betting against the casino. Okay. You don't want to do that if you're serious about your money. If you want to go to Las Vegas, put away $1,000 or $2,000 and blow it and have fun. But don't do that with your fortune. Don't do that with your fortune. Put the odds in your favor. Buy things where the PEs are at a low, and we'll look at a specific case in just a moment. You can get that information. You say, well, Richard, where do I get that information from? You can get that information from Thomson Reuters, and I'm going to show you a chart in a minute. That will be taken from Thomson Reuters. If you have a brokerage account with Fidelity or TD Ameritrade or E-Trade, those are three I can vouch for specifically, they do provide these charts from Thomson Reuters, so you don't have to do a lot of arithmetic yourself. You can just, let's say you're interested in XYZ company. You just get a Thomson Reuters report from your broker, and they'll have a chart showing the 5-year PE range. So you don't have to do any computations. Just look. Just look at the pretty squiggles, okay? And you want to buy stuff that's close to the low of that 5-year range, or at least a 3-year range, okay? Maybe you won't be able to buy it at a 5-year low, but maybe a 3-year low, something like that. And you can get those charts from your discount broker. And I assume a lot of folks here have accounts with discount brokers, okay? So I use Fidelity. Fidelity has a wonderful set of charts from Thomson. Use them all the time. And then you want to find dividends that they may not be at the absolute high, but at least they're off the bottom and they're closer to their high, the high range of, let's say, the last 3 years. You probably won't find them at a 5-year high. Not today. Market's too high for that. You won't find dividend yields at a 5-year high, but maybe you'll find them at a 2 or 3-year high. At least you're getting some value there. And there, I recommend going to a little website, free again. I'm always trying to give you free advice if I can, called GuruFocus.com. And we'll look at one of their charts in just a second. But Guru Focus has some free charts of dividend yields, historical dividend yields. So you want to buy things that are closer to their high than the low. We're not being absolutists here, but just closer to the high than the low. That's how you buy wisely. All right, here's our case in point. I've been flogging Pfizer for a couple of weeks here, the healthcare titan, PFE, and we'll be looking at some of the attractive value metrics in a moment. Upside from merger opportunities. I changed the title of that slide. I think in your handout it says something about the Allergan merger, but as you heard this week, they've decided to back out of that Allergan merger. And do you know what's happened to the stock since they abandoned that merger? Up. Now, isn't that interesting? Like most analysts, I was kind of working with the merger. My baseline case was that the merger would go through. And I was thinking about what the positives could be. First of all, it would be a lower tax rate, but that's not going to happen now because of the latest Treasury regulations, and that's why the merger is not going to go through. Both parties have abandoned it because the new Treasury regulations will not allow Pfizer to reincorporate in Ireland. But why has the stock gone up even when the merger fell through? Now, there's an interesting case. Why would that happen? Well, I think it's gone up, even though the merger hasn't gone through, because what has happened in those months since the merger proposal was announced last fall? What has happened is that the whole biotech industry, basically all the stocks in the biotech industry have taken a nosedive. They're selling on average almost 20% below where they were last fall. And so now Pfizer, instead of buying Allergan, an Irish-based company, can look all over the USA, does not even have to go outside our borders, and can find lots of interesting biotech companies, some larger, some smaller. They're selling at much lower prices than they were 6 or 8 months ago. Sometimes dumb luck can really pay off for you when you don't get your wishes, you know? That's happened to me many times in life when, you know, maybe I would have had some money coming to me and I wanted to invest it right then and there, and for some reason the money didn't show up. The check was delayed 6 months. And then 6 months later, the market was lower, so it's better I didn't get my wish. And that's exactly what happened with Pfizer. They didn't get their wish. They wanted to merge with Allergan. That's out the door. But now, 6, 7 months later, they have many more opportunities to buy biotech companies at lower prices. So that is why the stock has been moving up. We're kind of playing around with the price to pay for Pfizer right now because the whole situation is in flux. I think, officially we're saying 30. We're going to try to get it at a pullback to 31. I'm not sure that's going to happen. So this is one where you've got to cut me a little slack. Let's watch it for a few weeks if you don't own Pfizer. I hope you bought some when I had recommended it a few weeks ago. I was building a big position for myself in that stock, and I'm happy about that I got it when it was down 29, 30, 31 even. But I'm hoping we'll get a little pullback here. We may, though, for those who aren't in it now, we may have to raise our target. Stay in touch. We, if necessary, will raise our target, our maximum buy price to something a little above 31. But 31 is what I've got my eye on right at the moment. Now, here's the analysis that I want you to go through, not only for Pfizer, but for any company you're looking at. This is a teaching moment. I'm not just cramming you with information. I'm teaching you how to do this yourself, how to fish for yourself, okay? Let's say you go to Fidelity. You're interested in some company. In this case, it's Pfizer. And I get it in my Thomson Reuters report. And this is the chart that will come up from Thomson Reuters, okay? And this will show you the forward PE. They also give the historical PE, but I'm more interested in the forward-looking PE because that tells me what kind of expectations are built into the stock price right now, what the analysts are expecting, okay? So if the PE is low, even on the basis of what the analysts are expecting, then probably the stock is reasonably priced. And here you are. And in the interest of full disclosure, let's look at this chart, the whole chart. Yeah, Pfizer was cheaper in 2011 than it is today. A lot of stuff was cheaper. The S&P was down around 1,000 back then. We're at 2,000 now. Some folks are going to be really stubborn and say, I won't buy again until it gets down to 1,000. Or I won't buy Pfizer again until it's selling at 8 or 9 times earnings. I say good luck. I hope you have a long life ahead of you. I remember one great newsletter writer who told me years ago, I can't give his name because he's now deceased, and you know, of the dead we say nothing but good. But he told me, I'm not going to buy this market again until I can get a 6% dividend yield, which he got in 1982. He served out the rest of his career, which ended just a few months ago, so 1982 to 2015, and he never bought at that level that he had said he was going to buy at again, okay? So if you get really stubborn, if you become hidebound, and you say, I ain't going to touch it until it gets down to the bottom of that chart, you may be waiting a long, long time. So don't be too stubborn. You've got to be somewhat flexible. Now, when you're flexible, you have to open yourself to the possibility of error. Isn't that correct? I mean, it could be that something happens. I don't know what's going to happen Monday morning. Something could happen to knock the market way, way down, and maybe Pfizer does go back below this 12 to 13 times earnings where it is. Yes, you have to. You're not infallible. I'm not infallible. We do make mistakes. Everyone in this room has made mistakes as an investor. But we're trying to play the odds. And if we play the odds the right way in enough cases, eventually we're going to do very well on balance. That's the whole idea, to do well on balance. The whole thing on balance is going to work out for us if we play the game intelligently. We won't be right every time, but we'll be right enough times to build a good fortune. And that's what you do when you buy Pfizer. Here we are at at approximately a 3-year low for the price-earnings ratio. That's pretty good in today's world. That's pretty good in today's world. Furthermore, the dividend yield, you can see this chart, see a little credit down there in the lower right corner from Guru Focus, free. I love free websites. And here I've charted the dividend yield over the last 3 years. And yeah, up around 3.8, that was close to a 3-year high. Yeah, I would love to have it at 4 or 5. That would be wonderful. But I don't know that's going to happen. And I don't want to be stubborn, especially when the market is starting to move upward, okay? So I'm looking for things that maybe could move faster than the rest of the market. It's at 3.8. If the yield came back to 3, do your arithmetic, that would be more than a 20% rise in the stock. If the dividend yield came down as a result of the stock going up. So there's plenty of upside in Pfizer if we just come back down to a 3% prevailing market yield. Assuming you buy today and then the price goes up, the yield would come down. If it came down to 3, it'd be like a 20% gain. Nice, especially in today's market with a conservative, safe stock like Pfizer. Okay. Other cheap drug stocks, there have been a couple we've talked about in the newsletter, all in that 3 to 4% yield range. AbbVie, Merck, Sanofi, we've mentioned all of them in the newsletter. And we have prices on those in the latest issue of the newsletter if you want to look at those, or also on our website. I think on AbbVie it's 59 is our limit, Merck 53, Sanofi, which is a French company, 42. You might ask, why not Johnson & Johnson? We do own Johnson & Johnson in our incredible dividend machine, and it's probably the best positioned healthcare company in the world in terms of its diversification, financial strength, and quality of management. However, J&J is pretty expensive right now. So I have a huge position personally in J&J. It's one of the largest holdings in my own portfolio, but I'm not buying it right now. We were buying it a little while ago. Maybe last year we were buying it when it was down in a more attractive price range. So I think J&J right now would be a hold rather than a buy. Okay, good. Now let's take a look at some sell indications. When should you sell things? I've had a lot of questions from people about that at the cocktail hour last night. A lot of folks wanted some more guidance on when to sell. And selling is always tough. At the moment, I wouldn't be a particularly active seller because I think the prices for most stocks are going to be rising in the next 6 to 9 months. But I'm going to give you this advice because it may be a year before we see each other again. And before then, it may be time for you to do some selling. So I'm teaching you now how to fish for yourself when it comes time to do some selling. Basically, you put the thought process in reverse. Instead of doing all the things you would do when you look to buy, you put the thought process in reverse when it's time to sell. So you'll be looking for stocks that are trading at a 3 or 4 or 5-year high in their price-earnings ratio. Anybody got some ideas of a few stocks that might be in that category right now? I'm going to frighten you. Shall I frighten you? Because you own them. I'm going to frighten you. Yes, the utilities. Utilities are very, very high right now. If you ask me what's the one thing I'm most worried about in terms of what happens in the next 3 to 5 years, it's a close call. I mean, I am worried about the possibility that something really goes wrong in the world economy and we have another 2008. Sure, I'm worried about that. You'd be a fool not to be concerned about that. But the other thing I'm concerned about is the thing that most people are not concerned about. And that is that interest rates could come back up. Maybe it's because inflation picks up again. Maybe it's because the global economy starts to act better and there's more demand for credit. Something causes interest rates to go back up again. Utility stocks would be badly hurt in that environment. And believe me, I'm watching that situation very carefully because I made a mistake with my oil stocks. I thought the good times were going to last longer than they did. And you know what happened to your energy stocks, right? They seemed invincible. They seemed invincible. They seemed to have a lock on profitable operation. And then what happened? In the middle of 2014, those rascals over in Saudi Arabia decided to open the spigots. And the rest of the story is that we've taken quite a hit on our energy stocks, haven't we? Okay, so it's when you feel best about these things, most confident, most complacent, it's when you have to be the most alert. So caution about the utilities. We've cut back on our utility holdings in the model portfolio, and I do worry about what might happen there because they're selling at a very high PE, a very low dividend yield. See that second point there on the slide. High PE, low dividend yield. The key, and this is something I think I've learned, I hope I've learned from my experience with the oils, faltering upside momentum. This is something you have to study from charts. There are various ways to measure momentum. The so-called relative strength index is one, and there are other technical indicators, rate of change indicators. These things get a little hairy because they involve mathematics, and some people just kind of tune out when they hear that. But there are mathematical ways to tell whether a stock's price is rising at the rate it was before, or is it starting to flatten out, kind of like the way people in rocketry will measure the angle of ascent of a ballistic item and look for the time when it's starting to curve over before it falls back to Earth. And we have these tools, and I will be watching very carefully for signs that interest rates are starting to rise again. Bond prices, treasury bond prices are starting to fall. And that would be, again, a warning that the utilities might be ready to take it on the chin. Okay, so I'm hoping that we can give you a timely warning. But you should be out there studying these things yourself. Don't leave it just to me to study it. You watch it yourself. Watch your own utility charts. And if you start to see, months go by and no new highs, just kind of bumping up against where the stock was 3-6 months ago, can't break out to a new high, these are warnings. Take some money off the table. Okay? So sometime within the next year, I think you're going to hear from me more aggressively on that subject of utilities. I'll give you a little case history since we want to do some instructing here. We can always learn best from other people's mistakes, right? Not our own. Biotech. A year ago at this time, everybody was keen on biotech. If you went to the Money Show in Orlando or any of these big investor conventions, all the talk was about biotech. Up, 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 up. And yes, look at that chart. Early on, up to July last year, biotech was cruising along. Everything else was falling apart, but biotech was cruising along. And if you owned those biotech stocks, you felt really good. You felt smart, didn't you? You felt very smart, smarter than those other people out there who were starting to lose money on their stocks. You were still making money in the summer of 2015. But there were warnings. Now, this is a momentum indicator that I have charted up there. This is from stockcharts.com, which is free. And this is the so-called relative strength index. And you can see that even as biotech was rising to its peak in June and July last year, the relative strength index was not making new highs. That's that first oval. And then even after the first drop, the biotech relative strength index was just flat, was not moving up to new highs. And it actually had fallen, the index had fallen, or the ETF had fallen below its 200-day average, which was not a good sign. This rolling over just below the 200-day average is a classic sign of declining momentum. And sure enough, what happened? Early this year, the biotechs fell out a bit. So this is the kind of chart, if you see this happening with your utilities, remember this chart. Are you going to save this? Please save this thing, this handout I've given you. Save this. If you see this kind of chart developing in any stock that you own, first of all, as it's rising to its height, the momentum is declining, then it starts to break down below its 200-day moving average, and then finally, that's basically your last call when it's trying to kiss that 200-day moving average. That's where the arrow is. We call that in technical terms, it's trying to kiss the 200-day moving average. See it reaching up, but can't quite reach that 200-day moving average? That's often the sign that a breakdown is about to occur. So this is a classic picture of an investment that's about to break down. And of course, you want to sell, at the very latest, you want to sell where the arrow is, because real trouble starts right after the arrow. All right. We talked earlier in the year about hedging. The good news is that you don't need to hedge right now. I think we can cover this very quickly, and then we'll get right on to your questions. We don't need to think about hedging right now. I will be watching for some of these technical signs, like the one I just showed you in the picture. If we started to see a technical breakdown again, like the one in the biotech chart, if we saw that happening in the broader market, I would certainly look for hedging again, but probably not until at least this summer, and more likely after the election. Now, why do I say after the election? Most likely, the market's going to be okay. We don't have to think about downside hedges until after the election. The funny thing is that except in crisis situations, 2008 was a crisis, but except in crisis situations, the market tends to celebrate anybody that gets elected president. It's kind of a strange thing. It's not a Republican thing, not a Democratic thing. It's more a matter of we've got it. The uncertainty is behind us. The mess is behind us. The nasty rhetoric is behind us. I mean, don't you feel that way sort of when an election's over? It's a relief. At least we don't have to think about this for a while. That's how we feel in New Hampshire after the primary is over. You know, they inundate us. I mean, I went to lunch with a guy a friend and subscriber back in February in a little cafe in Portsmouth, New Hampshire. And doggone it, I sit down there, and who's behind me but Carly Fiorina? And she scolded me for not promising I would vote for her. You know, so I'm glad that stuff's over for another 4 years in New Hampshire. And so this is how it is with elections. The market celebrated the election of Jimmy Carter. The market celebrated the election of Ronald Reagan. Two people who are, very different in terms of their policies. So I think, generally speaking, as long as we don't face some kind of financial crisis, the market will tend to rise until after the election. So we don't have to start thinking yet about any kind of hedges. We can put that aside for now until some of those technical indicators suggest problems are coming. What are the true safe havens? And here I'm just basically telling you what I promised to tell you when we sent out the literature for this seminar. The real safe havens are cash, treasury securities, and those inverse funds like the ones offered at ProShares, the ProShares funds that will allow you to short the market. Those are the true safe havens, not gold. No, gold is not a good haven against a deflationary credit contraction like the one in 2008. Gold went down with everything else in October 2008. I'm not saying I'm against gold. I actually think gold may do fairly well in the next few years. But if I were buying gold, I would be buying gold for the reason I would be buying oil and oil-related investments in coming months, because I'm expecting the central banks of the world to try to reflate the world economy. I think inflation's coming. They're trying their hardest. They'll drop money from helicopters if they have to. And in that kind of environment, some hard assets do belong in your portfolio, like oil or gold. So I'm positive on gold, but not for the reason that these end of the world people say, that we're going to have a terrible crash, 50% drop in the stock market. If there's a 50% drop in the stock market, gold is going to be liquidated too, because a lot of the people who own gold also own stocks, believe it or not, they do. And many of them are these big hedge funds. You read it in the press, they'll tell you, big hedge fund, Stan Druckenmiller's got 20% of his wealth in gold, and a lot of hedge funds do own gold, and if their stocks go down the drain and they start to get margin calls from their brokers, they're going to have to sell some of the gold too. So the gold will be dragged down. If you're expecting that kind of collapse like 2008 again, your gold is going to be hurt too. But I think gold could be a good investment in the longer run because of the attempt to reflate the world economy. And utilities too. I'm hearing this, people say, but I'll be safe in my utilities. Look at the charts back in 2002 and 2008. When the market went to the ash heap, the utilities got hurt too. So your real safe havens, cash, treasuries, and inverse funds. That's where you want to be. Okay, well, I think we've found a path towards safety. My essential message is that you want to be positive for the remainder of this year. I mean, I'm thinking even out through the election, it should be a good time to be investing. But be careful. Keep your feet on the ground. Buy things that represent real value, discounted compared with where they've been in the last 2 or 3 years. Don't be stubborn. Don't hold out for the bargain that will occur only once in a decade. That's probably not going to happen in the next few months. Might happen somewhere out there further, but not now. So if you're trying to operate right here and now, be flexible. Take the signal that you want to be more positive now. You can be a little more aggressive now, but don't overpay. And as long as you follow those basic precepts, I think this is going to be a decent year for us. I really do. I think we're off to a decent year, and it could be surprisingly good. Wouldn't that be nice if, in spite of this nasty presidential campaign, we end up all smiling on December 31st? I would like that. Wouldn't you, Amy? I would. Yeah, she'd like that too. Okay. Very good. That's the end of my formal remarks for this session, but we've got some time for questions. And then at 9:15, we'll take a break. You can do whatever you need to do in those 15 minutes till 9:30, and then we'll come back for session number 2. But let's see if anybody has a question. Now, Amy's got the microphone. She'll bring it to you, so you don't even have to get out of your chair. Okay.
Thanks, Richard. Really enjoyed the first presentation.
Thank you.
Good stuff. You mentioned your fear of rising interest rates, and all I wanted to ask is, do you really think there's a chance they're going to go up very much with Europe and Japan and their negative interest rates? How can interest rates go up very high with that going on?
I don't think interest rates can go up this year very far, for exactly the reasons you're citing. And I guess the historical template I'd encourage you to think about is what happened during the 1930s and 1940s, because I think that's really the most analogous period in history to what we're experiencing right now. The funny thing is you hear very few people on Wall Street talking about that. I don't know why, if they just haven't read history or they have some agenda and they don't want to talk about that era because it has so many bad memories for so many people. But I see a lot of similarities between the 1930s, 40s, and where we are now. Fortunately, we've not gone through as wrenching an experience as the Great Depression, but we have had the persistent threat of deflation. We've had abnormally high unemployment for a long period here since 2008, and the inability of the banks, the central banks, to kind of bootstrap us out of that situation. So there's a lot of similarity there to the 1930s and 40s. And I guess what it teaches us, if anything, is that it can take a long time for those interest rates to turn around. Really, we had zero interest rates, money market interest rates in the USA from about the time that Franklin Roosevelt took office in 1933 at the bottom of the Depression, all the way through World War II till 1946. Okay, those are the relevant years. 1933 to 46, you had the zero interest rate. For the first part of that, it was the Depression. Then came World War II, and the government wanted the Fed to keep rates at zero so that they could finance the war. Okay? What's analogous today? I'd say maybe the first few years of our post-crisis experience have been sort of like the Depression. You had a lot of things were you had a crash in housing, and the government had to kind of put a Band-Aid on that and for the first few years and keep rates very low to just kind of lift that segment of the economy up again before we could even stabilize. Now we haven't got World War II here, but we've got it seems this persistent problem with Europe and Japan. They just don't seem to be able to get going, and China is now slowing down. We'll talk about that in our third session, I guess that is. So the central banks are facing all kinds of deflationary pressure that they're trying to offset, and that's why the rates are so low. Now, will that situation persist indefinitely? It felt that way in 1946. Have you ever watched It's a Wonderful Life? Go back and get that movie out. There are a number of lines in there where they're talking about how now that the war is over, we're going back to the Depression. That's what people were talking about. A lot of people were afraid that we'd go back to the Depression, just like the talk we're having today. You hear people say, we're going to have another crash, another 50%, or it'll be just like '08, only worse. Right? It sounds to me a lot like what people were saying in that movie, that the Depression's coming back. And you can't rule out that scenario. That could happen. But what happened after 1946 is that things weren't as bad as they expected. And one by one, little surprises. Corporate earnings started to improve. Took several years. It really wasn't until after 49. Actually, the Fed finally gave up on low interest rates in 1951. So that was from 1933 to 51. That was the last one. The Fed formally threw out that low interest rate policy, 1951. So it was 18 years. So we may have a while yet to go. But I think things happen faster nowadays. So what I'd be watching for, what will you be watching for? I'd be watching for commodity prices to come back, if they came back fast. If oil prices came back fast, and gold prices, and iron ore, and you name it, copper, those things that have been so depressed. If those things come back fast, if unemployment drops further, if you start to hear that corporate earnings are doing well again, those things will all sort of pressure the interest rates to go in the opposite direction. So I don't think it's now. But we've got to be watching for what's coming over the horizon, because I was fooled by the oil crash, and I am not going to be fooled when these interest rates turn around. Okay, so I may be sending all kinds of, tooting all sorts of warnings, months, maybe even years before it happens, but I want to be focused on that when it happens, because when it happened in the 50s, the people who were stuck in bonds especially, oh yeah, and even more so than utilities, because remember, utilities can raise their dividends to kind of keep up with interest rates, but the bondholders really got taken to the cleaners. And I'm worried about that, because I hear from a lot of subscribers who say, I'm having so much fun with my municipal bonds. They've done so well for me. My municipal bonds have done very well for me. I made a lot of money in municipal bonds, and I'm feeling pretty good about that. But the bondholders were taken to the cleaners in the 50s, 60s, and 70s. So when this thing turns around, you've got to have an alternative plan. Okay? This is not an immediate warning, but don't fall asleep in your seat. Okay? Good.
Good morning, Richard. Thank you for your consistent and crisp analysis. Two quick questions, I guess. Who would you comment on in light of your comments on telecoms, and then in the pharma space, might you have an opinion on AstraZeneca?
Yes. First of all, the questions about telecoms. U.S. telecoms are in much better condition than foreign, basically speaking, because the regulatory situation in the USA has allowed Verizon and AT&T basically to exist as a duopoly, and there's not a lot of control on their pricing, which is really quite remarkable when you consider the attitude of the government towards business generally. They've not really clamped down much on either of those. So I think you're okay in the U.S. Telecoms, but again, the same caution would apply with regard to utilities, because they've come up a long way. Verizon and AT&T are both right near multi-year highs. And the dividend yields have come down. So I wouldn't be adding to them right now. I wouldn't be adding. And if I saw evidence that rates were starting to turn around, the telecoms would get hurt, probably even more than the electric and water and gas utilities. Why would that be? Because there is more competition between those two big guys, AT&T and Verizon, than you would have among electric utilities. For example, most electric utilities are still essentially monopolies, whereas in many parts of the country you can choose whether you're going to have Verizon or AT&T as your cell phone provider. In many places you could do either. And so there's direct competition between those two. That's a different thing. That's a different thing, and that's a much riskier situation potentially. So it's okay. I still have plenty of AT&T sitting in my portfolio, but I've cut back a little in recent months because I'm concerned about this interest rate thing. About AstraZeneca and why, I think if I owned it, I'd be okay with that, holding on to it. Astra and Glaxo both have kind of a policy that is oriented towards the British investor, and that is that they pay out a very high percentage of their income or their earnings, their profits, in the form of dividends. A very high payout ratio. And that is not such a good policy, in my judgment, for a drug company. You need to put money back into research. We'll talk about, I think in our next session, my favorite drug company of all right now is Roche Holding in Switzerland. And we'll talk specifically about that. They are great about pouring money into research and development. If you pay out too high a percentage of your earnings in the form of dividends, you cannot maintain the research budget that you need to bring out new drugs. You see, the lifeblood of a drug company is new products. So you've got to pour money into research and development. That's what Valiant did not do. That's why it's such a scam. It's an absolute scam. I don't know why Ackman keeps touting Valiant, because they spent almost nothing on research and development, and that means when your patent portfolio runs out, you're going to have nothing to replace it with. So it's a scam. Why he's in this, I don't know. Okay, we can take one more.
Thank you, Richard, also for a good presentation. Do you have a question about the overall stability of things? You seem to think that things are going to be okay for this year. Excuse me. And yet, I've been reading reports about the financial institutions and the huge amount of derivatives that they own. For instance, Deutsche Bank and JP Morgan have like 10 times the value of derivatives to their capital. Do you see that this is a near-term problem, or do you think this is something that they can handle?
I don't see it as a near-term problem because I think the authorities since 2008 have required the banks to do some things that have lowered their risk profile. For one thing, banks on both sides of the Atlantic are now required to hold much higher levels of capital than they did in the pre-2007 era, let's say. The other thing is that in many countries, the derivatives now have to be cleared through a public exchange so that you don't have deals being made on the side, over-the-counter deals being made by banks, and it's much more transparent than it was before. So what people's liability actually consists of is a little clearer than it was in that previous period. That being said, though, I am concerned about the European banks. They're not as well supervised, they're not as well capitalized as our U.S. banks. And that's why, at the moment, if I were buying bank stocks, and I am buying some bank stocks, I'd be buying the very high-quality U.S. banks like Wells Fargo. Maybe Morgan. Morgan would be perhaps my fourth out of four that I would buy, but only because I have great respect for Jamie Dimon's ability to maneuver the business. I think he's a great manager. But Wells Fargo would be my number one. Maybe U.S. Bancorp, headquartered in Minneapolis. That would be another good one. Very conservatively managed banks. BB&T here in the South, based in North Carolina. Those would be three, and maybe Morgan, but Morgan would be my fourth pick, if any. But I think right now I'm emphasizing U.S. banks because they're more tightly regulated than the European banks, and they have stronger capital bases. But if the economy started to go south, all of the concerns you talked about could very well come to the fore again. So this is a watched pot. This is not something we just walk away from. Okay, those concerns that you voiced are legitimate, and in a bad economy, they would come back to haunt the banks. Okay, so we've got to watch how the economy is doing.